Hey everybody, Average Gamer here, aka Rob, and today I want to do a little investment video. So a lot of people are freaking out about the recent 6% increase average for Games Workshop miniature stuff. Me personally, I'm not too impressed with it, mainly because I know the financials of the company, and there's no reasoning for this except for, well, I'll get into it. But I see a lot of people complaining, and the main reason why they think it's going up is because of the cost of stuff for Games Workshop and a few other things. And I want to say the reason why the price is going up is not because of what anyone expected. So some people are saying is, okay, well, the stuff's getting, your stuff is being more expensive. Cool. But you keep raising the prices. What's your profit margins and stuff like that? Well, I'm here to tell you what they are, and I know exactly why the prices are going up 6%. Number one is because Games Workshop is increasing their dividend to their stockholders. So, of this 6% increase, they're almost doubling their dividend to their investors. So, we're going to look at the dividend right off the hop here. More specifically, we're currently sitting at a 1.8% per year dividend. But Games Workshop has announced an increase in their dividend to 3.2%. Interesting, right? So now it's going from a 1.6 pounds per year per share to $2.96.4, or we'll just say 2.96 and a half pounds per year. Very interesting. So almost $3 or £3. Interesting, eh? It's interesting how they announced their price increase. And if we come over here to, well, not Future Growth, Company Overview, they just announced, and here it is right here, the article, about their increasing of their dividend. It's very interesting how it's like, hey, we're increasing our prices. Oh, by the way, hey, shareholders, we're increasing how much we're giving you. It's very interesting. Why might you think they're increasing the dividend? In this case, charging people more money for minis. It's pretty simple. Their stock is in the process of kind of fluctuating back down to pre-COVID numbers. So if you look, the stock was slowly going up. It was going up okay. We're looking at an increase of, say, 50, we'll say about $16 every 2 years. So it was steadily going up. I mean, they're the only company in the market, really. But then all of a sudden, COVID happens. They have a drop down to, $47 pre-COVID. But then all of a sudden, it starts to spike within a year. And they go from $60 to $100. It's a $30 increase in 1 year in comparison to the years before where it's been about $10. Then you look, and of course, things are humming along. Now the COVID restrictions are releasing, the COVID restrictions are easing. People are going out and doing other things other than ordering your minis online and staying at home and painting. And we start seeing the drop. Now, around here is where we actually get the rumblings and the rumors of the increase of the dividend, because they're going back to, look at that, the pre-COVID stock price. Why? Because people aren't buying their stuff as much anymore. So if we go down and we look at things like Future Growth, you'll notice that over the last couple of years, there's been a spike in growth. And then all of a sudden now, it starts to kind of stagnate a little bit. Why is that? Well, and actually it went down a little bit. At the latter half of 22 and the beginning of 23. And the reason for that? The COVID restrictions are easing up. Basically, they're freaking out because their stock price is starting to drop. They want to increase that price or keep it copacetic, keep it at a high number, because that means the company's worth more money. And by doing this, they have to do something about it. By doing something about it, you have to make it more tantalizing for people to buy your stock. In this case, you're the only company in the market, really, so you're already going to guarantee to, do good over the next couple of years, because you're the only one in this, right? So you have really no competition. But what happens? They're going to go back to pre-COVID numbers, so they're freaking out. Oh crap, our stock's going to go down. It's going to go down about 50% probably. It's already dropped 50% almost since COVID. You'll notice it's even being classified as an overvalued stock by almost 86%. Everyone's like, well, this stock should be about $50. So right now, what they're doing is they're trying to keep that stock price high. And by doing this increase, they can throw more money at the dividend and make more people want to buy the stock and artificially keep that price high. How are they doing this? Well, they're increasing their prices. That's it. Let's look at their financial health. Oh, look at that. They are financially fine. They have no debt. Zero debt. Finding a company that's in the billions of dollars and having zero debt is ridiculous. I say billions of dollars because it's 250 million euro, or sorry, UK Great British pounds, which basically is times 4 to Canadian dollars. So it's about $1 billion company. It's funny. They haven't taken on debt in the recent, we'll just say the recent history, going back to 2016. No debt. Look at that. Their equity just keeps going up and up and up and up and up. Let's look at how much cash they have, shall we? Oh, look at that, eh? So these are all from their financials. But we're going to look at pre-COVID. So we'll look just before 2020. We'll look at right here. Boom, 2020. It's funny that there's a jump when COVID starts happening, eh? Because people are staying home and buying their stuff. Well, when you're buying stuff directly from the website, because the stores are closed, and and you're saving money on staffing that way, well, look at that, eh? Now the restrictions start to ease, and it starts to come back down again. But yet again, no debt. So this company is very, very, very well financially right now. 1.74 million Great British pounds of assets. So we're talking like buildings and things like that. And 47 million pounds of liabilities. Short-term liabilities, not long-term liabilities, short-term liabilities. This company financially is ridiculously well. They have currently 85.2 million pounds in cash and short-term investments. That's money that the company has invested in things. Physical assets, that's property and stuff like that. Receivables, inventory. They currently have 31.8 million pounds worth of inventory. So that's like models, paints, brushes, you name it. It's all in there. Even probably just generic resin that hasn't been turned into anything yet. This is just their assets. Liabilities wise, this company is beyond healthy. There is no reason for them to be increasing their prices, except for the fact that, oh, look at that. Their dividend goes from 1.8 to 3.2. Oh, hey, we're increasing our prices. By the way, shareholders, you're getting that money. But, our costs have increased. Well, not really. Especially because you're paying out for every dollar they earn, 69 cents of that dollar goes to a shareholder. How about how much cash they make? Well, 47 cents on the dollar goes to shareholders. It's very interesting, eh? Also, the CEO makes 1.3 million pounds. Wow. So the fact that, let's see. Let's see how much free cash flow they have. Oh, look at that. It's going down now. So this, just free cash. What cash from operations? Oh, look at that. That's going up as well. How about your operating expenses? Let's look at your operating expenses versus your revenue. Look at that. So your operation expenditure is $1.33 million or million pounds this year. Interesting. What was it before COVID? 108 million. So you've increased your overall expenditures by $30 million. Really? So from 2020, it's like November 30th, 2020, your operating expenses were 1.8 million pounds. Your revenue, the amount of money you were making, was almost £3 million a year. Interesting, isn't it? Then it dropped initially during COVID. But then, notice this significant change here. We're talking today. 133 million. Revenue's now 430. Revenue has almost doubled. Operating expenses gone up a little bit. So when they're increasing their prices, they're not increasing their prices because expenditures for their overall operating costs have gone up. No. You see, they've increased their prices because they're paying out shareholders more. So this increase is just going into the pockets of the shareholders. It's very funny that, the stock information that you can get and find out what the real reason why the price is going up for them is just this simple. They want to pay their shareholders better so they can keep their stock validation higher, or their stock price higher. Once again, the stock is going down until they announced over here the increase in the dividend. What do? They also then announce a price increase to cover said increase of the dividend. That's the real reason why they increase their prices. Not because of increased business costs, though operating costs have gone up by $30 million, but they've also made an additional $2 billion in revenue in the last 5 years. So, wait, no, sorry, not $2 billion. I was wrong. What was that number again? Sorry. So, their overall, no, that's earnings after taxes. So yeah, earnings themselves have gone down. Look at how much money they made, because we're talking brass tacks, right? So their operating expenses have gone up by 30 million over the last 5 years. So because they're citing operating costs have gone up, and that's the reason why they're increasing prices by 6%. But when you look at the numbers, you're like, well, your revenue was almost 3. We'll say 280, and now your revenue is now 430. That's a $200 billion increase almost in revenue. Well, a $30 million increase. So we're looking at 200 million versus 30. So that's 170 million difference. Just proof. They're lying. Revenues are up. Operation expenses are up, yes. But the fact that you're increasing the dividend by almost 2% up to 3.8 from 1 point something, that's the reason why you're increasing prices. Especially because you also have pretty much no debt, which is very interesting. Your company is in such financial okay, like it's financially perfectly fine. But God forbid that you tell people the truth. You're just trying to artificially keep your stock price up. That's why Games Workshop is increasing the prices on average 6%. It's not because of anything anyone think of other than the fact that they're trying to keep their stock price up. They're financially in any company, billion-dollar company, would kill for this kind of financial sheet. They're basically just printing money. But of course, maybe they got to get hit in the, in the price in the wallet a little bit, so people can see that hey, you're paying your shareholders on the backs of all these people. Are people going to be spending $190 for 12 little minis? $60 to $70 for 4 or 5? I think if you don't do something quick, you're going to lose your customers. But yeah, that's just my little 6% opinion. Who knows? Bye-bye.